Well, I need help, Chuck.
You don't need help.
You can answer all the questions, right?
That's right. All right, we ready? All right, thank you, and appreciate your coming to this press conference on gimmicks and taxes. The Democrats' reckless spend and tax spree relies on a number of budget gimmicks in an attempt to hide the true cost of its misguided policies. There is no single year in which all tax provisions in the bill will be in full effect at the same time. The child tax credit and earned income tax credit provisions expire after just 1 year. Yet the Democrats have consistently said this is intended to be permanent. The SALT giveaway is front-loaded while corresponding offsets are back-loaded. And the boost in IRS funding is estimated to generate less than half of what the administration claims. And even that does not formally score under CBO rules. Now I want to point at the first chart here. This is a summary. This is our chart, but the data comes from CBO, which is the blue line, from the Penn-Wharton study, which is the, I guess you'd call, purple line, and from the Committee for a Responsible Federal Budget, CRFB, which is the red line. So the blue line shows that, as written, with all of its gimmicks, the Democrats are able to get CBO to score the gimmick-ridden bill at $1.7 trillion. Penn-Wharton and CRFB have acknowledged what everybody knows and what the Democrats have been saying for months, which is that the policies they have in this bill are intended to be permanent. And it's very clear to me that that's what the ultimate objective is. And if you analyze the bill based on the intentions of the bill and run it out to a full 5 year or 10 years, Penn-Wharton, as is shown in the purple, comes out at a total cost for the bill at $4.6 trillion, and the CRFB comes out at $4.9 trillion. They are several $100 billion apart, but both clearly show that the full cost of the bill, the true cost of the bill without gimmicks, is above $4.5 trillion and approaching $5 trillion. They also talk about deficits, all three of these entities. CBO, scoring the gimmicky bill language, says there's still a deficit. Remember the claim that there's zero cost here? Even if you take the bill with its gimmicks, it's got $400 billion of deficit, according to CBO. And if you don't take the gimmicks, it's got $2.7 trillion of deficit under the Penn-Wharton study and $2.8 trillion of deficit under the CRFB study. Now, these charts tell it all. But let's go on just a little bit. We have all seen that these proposals that are included here are driving, along with the previous policies and enactments that the Congress has seen happen in the last 2 years, a significant impact. They do nothing to address rising consumer prices and supply chain issues, but the taxes that are in these proposals, the revenue that is included in these proposals, includes more than $800 billion of tax increases on American companies with supply chain issues and worker shortages. And study after study shows that these so-called corporate taxes fall mostly on labor and capital. That's on workers, jobs, salaries, and benefits, and on investors, retirees, and pensioners. That's where the burden of the taxes fall. The Democrats' book minimum tax would overwhelmingly hit American manufacturers, workers, and pensions. And even the Tax Policy Center, which generally leans toward the Democrat side, has acknowledged how harmful the book minimum tax would be for capital investment in the United States. International tax increases would overwhelmingly hit American companies operating globally, not their foreign competitors, giving China yet again another advantage competitively. And finally, these tax hikes would hit workers and consumers hard in addition to the record inflation that they're already causing. This chart shows the inflation since 2017 coming forward, and you can see in red what has happened as a result of the administration's tax and spending policies so far, and why we should stop this reckless tax and spending proposal. With that, Senator Grassley, you were here first. Why don't you go ahead?
I want to focus on the impact on small business. But before I do that, I'd like to make a point as a member of the Finance Committee, and you folks report on it. You always hear Democrats saying corporations ought to pay their fair share. What you don't see in a lot of their tax proposals is it's just like everybody in small business is a tax cheat. We got to do everything we can to collect all the money that small business isn't paying. Another fact, before I get into my point, is the fact that we got 6 million people that haven't entered the labor force since the pandemic. But what doesn't show up, and it's been talked about in the last 2 weeks in newspapers, at least 1 4/10, and another figure was 1 6/10 of those people that aren't on the returning to work are setting up their own small business. 1 4/10 or 1 6/10 million people just starting their own business because they don't want to go back where they were going to work. So now we're faced with this tax bill that's going to hit small business. And you're going to, well, I guess the point is, this is what I'm hearing from Iowa small business. It's going to be very detrimental, these tax provisions and this wild-eyed tax and spending spree bill that could come before us just hurt small business, Main Street businesses. And they're the lifeblood of our communities. And they're also faced with input into their business with a 6 2/10% inflation tax that everybody's paying, not just the small business, but everybody's paying it. Just like paying a 6 2/10 increase in your state sales tax, as an example. So this Biden tax cut, tax increases are hitting small business, hurting our Main Street, hurting the backbones of our communities, and instead of helping small business, they're hurting small business. Instead of helping middle class, because that's what most of these small businesses are, they're hurting middle class. And as we said last week, this is a blue state billionaire bailout, not something that ought to be helping the people that it ought to help.
Thank you, Chuck. Senator Hoeven.
Simply put, this massive tax and spend bill is the wrong approach. As you saw last month, inflation came in at 6.2% on an annualized basis. That's nationwide. But in the Midwest, where I'm from, 7.3%. And think about it. We're a huge energy-producing state. We're a huge ag state. So those costs are coming through to consumers as well, which means that the inflation problem is not lessening, it's getting worse. And who does that hit the hardest? It hits low-income people the hardest. Think about seniors on a fixed income. Think about seniors on a fixed income when they go to the gas pump and they're paying more than $1 a gallon more than they were last year. Think about when they go to the grocery store. You all go to the grocery store. You know what that bill looks like. And here we are, we just had Thanksgiving, we're going into Christmas. So that inflation hits everybody, but it hits low-income individuals and seniors on fixed income absolutely the hardest. And then add to that the supply chain problems, right? We have 4.4 million less workers in the economy working now than we did in February of a year ago. 4.4 million less. But you've got 10 million job openings right now. You wonder why you got supply chain problems? The Democrat policies are disincentivizing people to go back into the workforce. So that exacerbates the supply chain problems and further increases inflation. And here we are going into Christmas with all this going on. So what is the solution? What's the solution that this administration and the Democrats are putting forward? More mandates, more regulations, more taxes, and more spending. Absolutely the wrong approach. Now, CBO has scored this massive tax and spend bill, and they say it's about $1.7 trillion in spending over 10 years. It's about $1.2 trillion in more taxes over 10 years. So about $400 billion in deficit, increase in debt and deficit. But we know that, as Senator Crapo just said, that's not right. That's not even close to right. This bill is full of gimmicks. The revenues in the bill are set up over a 10-year period. You know this. You've seen it. The revenues are set up over a 10-year period, but the spending programs expire in some cases, supposedly expire at the end of 1 year or at the end of 3 years or end of just a few years. But we know that those spending programs are not going to expire. The Democrats are going to continue those programs. They've already said they want those programs to be permanent. So you're matching a few years of expenses against 10 years of revenue, and you're still coming up with almost $500 billion in deficit. Clearly, this is far more spending, and it's going to add much more to the debt and the deficit. So this is, again, this is absolutely the wrong way to go. People need to understand exactly what's in this bill, understand these gimmicks, and say, no, this is not what we need for our economy and for our country. We need to get back to the kind of pro-growth policies that benefit all Americans. We need to stop this massive tax and spend bill and get back to pro-growth policies that benefit everyone.
Thanks, John. Senator Lankford, then Senator Mosley.
You know, it's interesting to me that the number of times that I hear the story change as this bill moves through the House and now comes over to the Senate. This massive bill that's sitting out there that's now almost $2 trillion with around $400 billion in additional debt originally was all about sustaining our economy. Then this very hot inflation continues to rise, and now suddenly it is, well, this is going to help us fight inflation. And now we're dealing with unemployment issues, and so now the Democrats' line changed to, well, now it's going to help us with employment issues. In reality, what's happening is they're trying to spend more, they're trying to tax more, and they're going to make a bad situation even worse in this process. So the continual tax policy tinkering discourages companies to invest and will discourage companies from actually basing here in the United States. Why do I say that? Well, they're raising the rate for companies doing business internationally here in the United States. And what they're literally doing is saying, we're going to raise the rate here, and every other country around the world promises in the future they will also raise their rate. Honestly, that reminds me of when I was in middle school around a group of guys that all came up with a bad idea, and all the guys would look at each other and say, great idea, you go first. That's what right now the Democrats are doing, is saying, you know, everyone's going to raise taxes, and the whole world is saying you go first. And the Biden administration is saying, deal, we'll try to raise taxes higher than anyone else, assuming in the future they're going to catch up. That's not going to happen. This book tax that they're releasing is a new alternative minimum tax. The alternative minimum tax has been a problem for years and years and years. The book tax has been tried in the past and has been set aside. This doesn't help, and it actually discourages investment in the future. To have companies have two different systems of how they're actually tracking their tax liability, and without question, it will hurt manufacturing businesses the most, who have the opportunity to be able to write off new equipment, and new expansion will then lose that ability, which means less purchasing of new equipment, less purchasing of new facilities, and less expansion and less jobs. That's exactly the wrong direction for us to be able to go in this tax policy. It's also interesting to me, my Democrat colleagues continue to be able to talk about, we're going to go out and soak the rich in this, until you actually see their proposal. When in their proposal next year, 3/4 of the people that make $500,000 or more, their taxes actually go down, while the people that make a smaller amount, just a fraction of those, actually their taxes decrease. So it's an interesting doublespeak in this process and how they're trying to set it up. They're also taking one big risk in this, that they can throw all this information out, that we can look at all the facts and the data that's there and examine it, and they're saying to reporters across the entire country, don't look at CBO score, don't look at any of the outside groups and how they've scored. By the way, we're doing a new tax credit for reporters. Just look at that. Examine the new tax credit for reporters that, hey, we're going to help you out, and ignore all the rest of the data. Quite frankly, I don't think even reporters are going to fall for something that blatant in the process, that we'll all look at the facts and the data, and we'll see the actual effect of this tax policy, what will happen on our economy.
Senator Bozeman.
Thank you, Senator Crapo. Thank you for getting us together to talk about this massive reckless spending bill that really has two problems. It's bad policy with bad pay-fors. As I travel around Arkansas and really throughout the country, I hear about inflation in gasoline, food prices. I hear about the labor market, how difficult it is. I hear about open borders. I hear about the supply chain. Instead of addressing the problems that Americans are so concerned about, Democrats are doubling down with bad ideas and then forcing Americans to pay for those bad ideas. Inflation, labor, supply chain, open borders, all of these things are so very important to the American people, and yet nothing is being done about them. This is what working families in America are concerned about. Now, fortunately, we've been able to beat back some of the crazier things that have been brought out, the stepped-up basis, making it such that you would dramatically increase inheritance taxes because of the pushback of the farm community, this would have been devastating to our family farms of small and medium size, also our small businesses, small, medium size. We were able to push that off the table. Sadly, there's a bunch of stuff that's still left. And I think early on, one of the crazy things they wanted to do was to make it such where you had the vehicle miles traveled, where they put a device in your car and it told where you went and the miles that were traveled, and then you got a bill every month. The American people said, no, we're not going to do that. The latest thing that's very much like that is this deal with your banking account. Right now, after you reach a threshold of $10,000 worth of activity, the average American family is $61,000, I believe. Then at that point, your information starts going to the IRS. It's equivalent to vehicle miles traveled in your checking account. So these are things that we're working very hard to defeat, and we're going to continue. We've made great progress, and I very much appreciate the leadership of Senator Crapo. He and his committee have done an outstanding job, and we're going to continue to press forward and try and make it such that the American public realizes that these things are totally out of step with their concerns and all about radical policies that the administration would very much like to get done, but the American families are going to be the ones that pay the bill. Thank you.
Thank you, John. And we'll throw it open for questions. We got a second vote either started or going on pretty soon, so we'll try to move as fast as we can. I appreciate you guys hanging in for this. And let's go right here, and then we'll go here, and then we'll look again.
A couple of questions. One, what does the true cost of the tax spending bill mean from a technical standpoint? As long as the Democratic majority can show that they are budget compliant, even if you use what you call gimmicks to do that, that's all they need to do to get it on the floor, correct? They only need to show that they haven't upset the CBO and they've met the budget, the bird rules to get it moving. And my second question, I can follow up.
All right. Well, first of all, you're right. The reason that the Democrats put these gimmicks in here was so that they could get the CBO score that would allow them to move forward. They were hoping that this number right here, the $400 billion cost, was going to be a zero because they were trying to get all sorts of scoring out of their IRS gimmick and several of the other gimmicks. They failed in that, but they can still move forward with the reconciliation bill. And I think that the fact that they are pushing so hard right now means that they fully intend to do so, which to me shows that they're willing to overlook the details of the scoring and simply do the voting that allows them to move forward and ignore the CBO score, even the CBO score, let alone these other scores.
And just to follow up, do you expect the majority leader to put this on the floor, despite Senator Manchin's uncertainty on his intentions if the bill is called up? He says, I don't know how I'm going to vote on this until I get to the floor.
Yeah, I don't know that I could tell you what I expect Senator Schumer to do because it's so unclear. But I can tell you that as of right now, we are doing everything we can to evaluate the language we have, which is the House language. We don't have whatever may be getting negotiated, if anything is successfully being negotiated right now. And so, again, the whole process depends on us knowing whether there is a change in the Senate and what that change is, which so far we don't know. So I don't know whether Senator Schumer is going to provide those changes up front or try to cram them in at the end. I just don't know what to predict.
Can I say one thing to that?
Sure, go ahead.
So I think the other thing to this is the idea that we're talking about the biggest spending bill in history, and no Republican has had any input, no Republican at this very late date, and you correct me if I'm wrong, you're in the middle of this.
That's right.
I'm in the middle of it with agriculture. $85 billion is going to be spent. I don't have a clue. I haven't been consulted at all, nor have any of the stakeholders. No hearings, no whatever. But the idea that we would go forward with this massive bill and essentially do it unilaterally is unheard of, I think, as far as precedent in the Senate.
Good point. See, I said here and then back there, and then we'll go here and here. Keep me in order. If you want to jump in, guys, jump in.
The expanded child tax credit expires at the end of this year. What do you think should happen to that credit? In particular, do you like the monthly payment feature that they've added?
Anybody want to hit that? Now, I personally opposed the entire bill, so I don't want to start getting engaged in a conversation about what parts of the bill I would support or not support. I don't like the mechanisms that they are using, either on the spending or the taxing side. And so I'm just not able to engage in a conversation about how I would improve or support different pieces of the bill. There isn't anything in this bill that is needed right now. We need to take the pause that Senator Manchin talked about and see if we can stabilize our fiscal policy. That's what we need to do.
What I would add is, look, the administration over and over keeps saying that this bill is paid for. Same thing with the Democrats in both the House and the Senate. They're saying, oh, well, it's paid for. Well, obviously it's not. How can you run 10 years of revenue against, in some cases, 1 year of expense and say it's paid for? That's ludicrous. So we're trying to point out what's really in this bill so people understand it, so they'll say, hey, we don't want that. We don't want that. And to stop this whole process, as you say, it's being negotiated. How is it that the public isn't even privy to the negotiation that's going on right now? So here we are, Mark, trying to say, okay, this is what's in the bill that we know of right now, but where's the transparency on the negotiations that are going on solely among Democrats right now? And how can you over and over again say something's paid for when you have 10 years of revenue against just a couple years of expenses, when those programs, by the Democrats' own statements, by the administration's own statements, are supposed to be permanent?
Okay, back here. Yeah.
The Joint Committee on Taxation told the House budget Republicans they estimate about 87 million Americans with bank accounts of $400,000 or less that still have their accounts reported to the IRS. Had that today. What are your thoughts about this? How concerned are you about this? And that it's still in the Democrat spending bill after the whole struggle and campaign against that earlier this year?
Yep. I'm going to hit that really fast, and then I'm going to let Senator Portman hit that and also make any statement he wants to make. So, Rob, get ready. All I can say is I absolutely agree with the joint tax statement. We actually have a joint tax report that we've put out a couple of weeks ago that actually goes through who will be hit by this new army of auditors that the IRS is seeking to get funding for. And if you look at where the tax gap supposedly is, interestingly, it falls mostly on those making less than $500,000 a year. And I think as you go down the increments, about half of it, roughly 40% to 50%, falls on people making under $100,000 or under. And so it's phenomenal numbers, and that's what the Joint Tax Committee was reporting on in the House report that they made. The fact is that as much as the Democrats claim that their IRS proposals will be focused solely above $400,000, the reality is that is not the case, and that's what the Joint Tax Committee has shown us. And the bottom line is, if they really mean that, then let's let them support an amendment, which I assure you we'll be bringing, that will say you can't do audits from this money on anybody making less than $400,000. Let's see whether they support that amendment when the votes come.
and add to that the SALT provision, state and local tax deduction, which is being increased from $10,000 to $80,000. Clearly, that's to benefit high-income individuals in the states of New York and California.
Rob, do you want to jump in now?
Yeah, I mean, look, there's only two things I don't like about this reconciliation bill. One is the massive spending, and the other is how they raise revenue, because they're both problematic. And this is one example where we did a lot of work on this, as you know, in the infrastructure package. And over the years, Senator Crapo and I have been focused on this IRS issue. How do you modernize the IRS so that it can be a more effective tax collection agency but respect people's rights? The numbers they're coming up with are totally out of line with what we found in our analysis, but also what Congressional Budget Office is telling them. So it's another example where, unless they're doing as the Joint Tax Committee says they are, which is going into people's bank accounts who are relatively lower income and creating incredible intrusion into people's lives, they're not going to raise the revenue that they're claiming that they're raising. So it creates a gap on the revenue side. So there's just so many issues like this with this legislation. Part of it is because you all and we have not had the chance to actually sit down and analyze it because we haven't been part of the process, and because no committee has been part of the process. So it hasn't gone through the Ways and Means Committee. It hasn't gone through the Finance Committee. So it's a good example. But let me give you a couple others. Senator Hoeven was just talking about the impact of the $80,000 cap versus a $10,000 cap. That in combination with the other provisions in this bill means that millionaires, people making over $1 million a year, are going to get a big tax break here. Over 68%, almost 70% of millionaires are going to get a significant tax cut under this legislation. Those between $500,000 and $1 million, 90% of them are going to get a significant tax cut under this legislation. However, if you're making $30,000 a year, only 30% will get a tax cut, and only in the first year. In the second year, it goes to 12%, third year to 10%, and down into single digits. So think about that discrepancy. The people who are going to benefit from this on the revenue side are the wealthiest Americans, and those who will be hurt are middle-income Americans and lower-income Americans. So whether it's the spending side or the tax side, there's a lot of issues in here as we flesh them out and look at them are very troubling. Let me give you another one that's very concerning to me. There's a 25% minimum tax on the domestic side for companies. It's called a book tax. So they're looking at, instead of the way income tax is calculated by the IRS, they're looking at what your book tax is based on your financial statements. Now, sounds innocent enough, right? As we begin to dig into this, we find out that this is going to affect defined contribution and defined benefit pensions, particularly defined benefit pensions. How? Because those pension plans, if they have an increase in their assets, currently are not taxed to the company, right? Because it's totally separate. So if you have a company that's, let's say making $100 million a year in profit, and yet has in its pension plan a $1 billion or $200 billion increase in the assets, maybe because interest rates have gone up, maybe because the market went up. Now, for the first time, that company is going to be taxed on those increases in the assets on the pension plan. Remember, $100 million over here, you got a $2 billion increase over here. You apply a 25% tax to that, you're bankrupt. I mean, what are your choices? You either have to go out and borrow the money to pay your taxes, or you have to say we're going to fold this company. Who does that hurt? That hurts the people that are in these defined benefit plans, which, frankly, Democrats in the past have always strongly supported. A lot of them are union plans, as you know. And we're encouraging, some of our friends in the union community to take a look at this. This is the impact of this so-called minimum tax. Again, sounds innocent enough, but it really hurts people. Second example might be bonus depreciation. If you're a small business, you've really taken advantage of this, but so have a lot of larger businesses who will be caught up in this book tax. So if you make an investment in expanding your plant or equipment, you can take an immediate write-off. That was in the 2017 bill. It's been very popular. Why? Because it's helped the economy and helped create jobs and economic activity. Under this new tax, this new minimum tax, it takes away that benefit for many companies to be able to get that immediate write-off under the bonus depreciation. I don't think anybody wants to do that. I think a lot of these are almost inadvertent. I can't imagine they would want to. But these are some examples, and you dig into this, whether it's the IRS provision you mentioned with regard to people's privacy and the burdens on individual taxpayers, or whether it's some of the ways these tax increases are going to hurt businesses and ultimately workers. By the way, the Joint Committee on Taxation and CBO and other analysis has said that when you increase taxes on companies, who takes a hit? Workers do, in terms of wages and benefits. 70% of the impact of these tax increases will be on workers. So this is the wrong time to do this, for sure. High inflation, uncertain economy, in part due to the COVID challenges we face, and record high debts and deficits. We know that this is stimulative spending on the spending side that will add to inflation. We all said this was going to happen back in March with the $1.9 trillion bill. Unfortunately, we were right. Much more demand going into the economy because you're supplying more of the stimulus capital into the economy, overheating the economy. That's what's caused inflation. On Friday, we'll know the inflation numbers from last month. I'm hoping soon we'll have CBO giving us an analysis of what the actual cost of this plan is, because everyone who's looked at it says the same thing, which is, yeah, as Senator Hoeven said, you got 10 years of revenue, but you're ending the tax credit after 1 year, the child tax credit. Is that going to happen? Historically speaking, no. Congress will extend it, and yet it's not paid for in this legislation. This is why the Penn Wharton study says it's more like $4.6 trillion. Others say it's more like $4.7 trillion. Even if it's close to that, that's twice as much as Congress has ever spent on any legislation in its history. Number one would be the $1.9 trillion from March, earlier this year. So my hope is that people will take a look at this and say, you know, this just does not make sense, particularly at this time, and make the decision to stop the stimulus spending, try to get inflation under control, stop the record debts and deficits, and bring more economic certainty to our country.
Thank you. We're running really slow, so I just got to go with the two I said, and then we'll have to wrap it up. So go ahead.
On the global OECD tax deal, half of that is in the bill, the global minimum tax portion. The other portion of that, the reallocation of profits, could require revision of tax treaties. Do Republicans
Correct.
intend to participate in the renegotiations and support of these tax treaties?
We have been pushing extremely hard on the administration, particularly Secretary Yellen at Treasury, to get them to commit to the fact that they will bring this before Congress and will engage with us, as they should, on treaties. So far, they have not only have they not agreed to do that, but they have said that there are other ways to accomplish this objective without doing a treaty. We have a huge disagreement with them on that. You can't basically redo all of our tax treaties in another big treaty agreement and not deal with it as a treaty where the Constitution requires that collaboration that you just asked about. We are ready and engaged and willing to engage on that, because we think that this has fallacies and problems just as most of their other proposals do. But at this point, we have not been able to get the agreement of the administration to let us deal with this as a treaty. Let me go.
On the massive spending and the inflation that we're going to be seeing, I wanted to just take a different angle, if we can, about Biden's vaccine mandates and how it's going to hurt small businesses. Can you touch on that and the importance of Senator Braun's bill passing as well?
Well, I'd love to have anybody here who wants to jump in and do so. Otherwise, I'll...
Well, those decisions need to be made by people, you know, with their health care providers, and we've got to find ways to get people back in the workforce. And that's one of the points we're making today with this inflation, with these disruptions to the supply chain. You're seeing people not being incentivized back into the market, but actually leaving the labor market. So we've got to find ways, you know, again, to get people back to work. That's what's going to address the supply chain, get this economy going. And again, it goes back to this idea, and I think we're going to have a press conference on this tomorrow, actually, so you'll be hearing more about it. But furthermore, this is a big-time overreach. There is no way that it's constitutional for the administration to try to go out and tell businesses that they have to enforce a vaccine mandate on their workers.
Yeah, I would just share that. The idea that an unelected bureaucracy, very small agency, can put forward this type of mandate in the form of OSHA, that sets all kinds of terrible precedent for the future. The other problem is there's a competitive disadvantage. This is for 100 employees or more. What if you've got 90 employees and you're competing against somebody who's got 110? So there's, you know, the unfunded mandates that are going to be on that. Again, them losing a significant percentage in many cases of their workforce. So there's all kinds of reasons to oppose this, even though I personally feel like we need to be vaccinated. That's a good thing. But it doesn't need to be by government decree from OSHA.
Thank you, everybody.
Thank you so much.